BHEL and Hitachi Energy fall for another session as the risk of more competition if the government eases curbs on Chinese companies continues to weigh on sentiment. The stocks continue to lose.
Tejas Networks is down 8% in trade as the quarterly revenue remains weak on a Y-on-Y basis. The weak sales and delay in major BSNL orders impact the company in the third quarter.
Real estate player Signature Global slips in trade after the company says they will fall short of their FY26 projections for pre-sales of nearly 12,700 crore amid a weaker macro environment.
And Avenue Supermart shares surge almost 3%. Post the company's quarter 3 numbers, the margins rise to around 8.1%. That compares with around 7.6% on a year-on-year basis, while the EBITDA grows 20% during the same period.
It's a CNBC-TV18 News break that's confirmed. Lemon Tree Hotels in green after it announced a major restructuring plan to unlock value, split its asset-light business, and bringing Warburg Pincus as a strategic investor in Fleur Hotels.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see, the market's in the red yet again. The only solace is that the Nifty bank at least has come off the low point of the day and the breadth of the market has improved a tad bit. But nonetheless, another down day, and holding on to the 25,500 mark, Mangalam, is going to be extremely, extremely important. Because otherwise, you can argue that there are a couple of parameters stretched, moving to extremes. But the selling, first out of trade, there's no trigger for the markets to be down 100, 120 points.
And there's no respite to that selling, despite the selling that we've seen for the 6th straight day, if you're looking at the frontline indices. And even as the Nifty bank has recovered from the lows, still sitting with a cut of almost 150 points, if you look at a couple of these auto names, they are selling off quite sharply, vociferously, in fact. Eicher Motors, the intraday chart of that one comes up for you. We're also seeing a big gash on names like Bajaj Auto, as well as Hero MotoCorp, the two-wheelers in particular. And if you pull up the auto index, that will tell you that there is weakening on that front. And also, the pharmaceutical names, which were doing well earlier, have come in for a bit of selling. Yes, the market breadth has improved, but still 2,150 stocks in the red for about 624 stocks in the green. So good time to welcome Shivangi Sarda of Motilal Oswal for a quick technical check on the market. Those lines run like train tracks. Shivangi, there has been no respite. The Nifty straight off the bat, down about 120 points.
For having me. So we've seen that profit taking has taken over most part of the week in the previous week that we saw, and it has been trailing in this week as well. We've seen that important support levels have been broken. 50 DEMA has been broken, and now Nifty is nearing another important level, which is 25,500 marks. Now, if it manages to hold these levels, then we could see some consolidation here. Of course, upside still remains capped because of the lack of follow-up that we're seeing in the broader market. But of course, if it breaks 25,000, then we're looking at 25,200 next on the downside for Nifty index. But of course, India VIX has also risen by more than 20% in the last 10 trading sessions. And we are seeing that there is some bit of concern prevailing in the market, thanks to the global geopolitical tensions as well. Talking about Bank Nifty, this one's comparatively resilient and is still holding above its key exponential moving average on the daily frame. And it has dropped less than the entire broader market. Of course, thanks to some of the PSU heavyweight banks that are still holding strength. Now, Bank Nifty hasn't, stepped down of 58,750 levels, which is an important support. This will be a make or break zone for Bank Nifty. If it manages to hold above these levels, then we could see some stabilization here with an upside target of around 59,500 marks.
Got it. All right, Shivangi, good to see you in. What about individual stocks? What's on your radar?
So, of course, Nigel, with this trend that we're seeing in the financial space, my first pick would be on Muthoot Finance. We've seen that this one has been quite resilient despite the market volatility. And we've seen that, this actually has been performing continuously from the last 35 months, maintaining an upward sloping channel. So quite a lot of strength here. Of course, we are seeing some bit of softness from the last 3 trading sessions, but overall it has correctly taken a support near its retracement level, which is looking quite positive here. So recommending a buy here with the next targets of round about 4,020 levels and a support of 3,770 zones. And the second pick on my radar would be Vedanta. We've seen Metal Pack has been outshining, and Vedanta has been one stock which has been resiliently more stable than the other metal counters which have seen a lot of swings. So Vedanta is one stock which is looking quite positive. It has given a pole and flag pattern formation breakout from the monthly frame, which is making a good upside potential for this one. So recommending a buy here with the next target of 650 levels and a support of 612.
Okay, all right. Thanks a lot for that, Shivangi. Well, let's turn our attention now to our special segment, where we get you a few ideas for profit from Money Control Pro. Lekha Badlani of moneycontrol.com joins us to talk about a stock that she's tracking closely. Lekha?
The stock pick is Landmark Cars, a leading dealer of premium and luxury vehicles in India, well placed to benefit from an improving demand environment and operating leverage. Following the temporary demand postponement caused by GST 2.0 transition in September 2025, which weighed on Q2 FY26 volumes and margins, industry conditions have turned favorable. Lower interest rates, reduced GST on ICE vehicles, festival season demand, and OEM-led promotions are driving a recovery in showroom footfalls and bookings. Passenger vehicle volumes have already recorded double-digit YoY growth in the October-December quarter, supporting a strong H2 FY26 outlook. Landmark's strong OEM portfolio remains a key differentiator, while Mercedes-Benz continues to anchor the luxury segment and support higher ASPs. A robust pipeline of new launches from BYD, Honda, MG Motors, and M&M is improving volume visibility across price points and customer segments. On the operational front, most of the Landmark's organic expansion is now largely complete. The focus has shifted to ramping up existing outlets, improving throughput and enhancing efficiencies, setting the stage for margin recovery as volumes scale up. Importantly, the after-sales business, though only 20% of the revenue, is a high margin and stable earnings driver. Lower GST on spare parts improves the competitiveness of the authorized service center, supporting steady cash flows and reducing earnings cyclicity. After a 25% correction, the stock trades at around 15 times FY28 estimated earnings and offers an attractive entry point for gradual accumulation.
All right, few stocks which are bucking the trend and currently doing better. Coal India is one, it's up around 3%. NTPC is the other one, which is up around 1% as well. And we are seeing some traction in trend. After the week last week that the stock had, seeing some recovery from the lows, up around 1%, sitting over that 4,000 rupee mark on that stock as well. Take a short break, come back, focus on a lot more stocks which are in the red than the number of stocks which are in the green.
Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. The markets continue to remain under some pressure. The hope is that at some point of time, we can see a bit of a recovery. I think first we need to stop falling, which is very, very important. And we need to defend this 25,500, 25,550 odd mark. But we're looking for some good news today. And Mangalam brings us that. Avenue Supermarts is a stock that's trading in the green. Mangalam, run us through some good news.
Well, Nigel, same time last Monday, the stock was lower. So that was bad news then. But now
you're giving us
the good news is coming this next Monday itself. The thing was that, when the company reported its quarterly update, 13% revenue growth, the street did not like that. They thought it's lower. But the sense one got that time was that maybe we have, realizations which are lower because of the GST cuts that have happened. And now that is confirmed in the numbers that are reported because margins have been a very positive surprise. Most on the street were working with an 8 to 10% revenue EBITDA growth after the company reported a 13% revenue growth. But the company has gone ahead and surprised. It's a 20% EBITDA growth and consolidated EBITDA margins where the street was expecting a compression has actually seen an improvement, and that improvement is gross margin led. So it means that there were lower discounts, and at the same time there was perhaps a higher share of revenue coming in from their own product labels on which the company has been fairly aggressive but not vocally so. Revenue growth, the management said, was partially impacted due to deflation in staples, but a 13.5% revenue growth on a consolidated basis does imply that there was 500 crore worth sales coming in from DMart Ready without an incremental EBITDA loss. That's a positive. And margins at around 8% with a net profit growth of about 18.3% as well. And the company last year had 16 million square feet in terms of retail space. Now that number's turned to 18 million. And average revenue per square foot hasn't fallen as much despite the realizations coming down. And the store additions have been positive as well. In the first 9 months of this year, they've added 27 stores. The street was working with a number of anywhere between 20 to 25. So store additions positive, margins positive. Two positives outdo the negative, which was revenue growth, which was obviously understandable and explained by the company.
Okay, all right, Mangalam, thanks a lot for that. Well, let's focus on Signature Global. From Mangalam, we hop across to Sonal. Signature Global, though, not very good news out there. Sonal?
Well, this is for the first time that the realty player has gone on record talking about tepid demand sentiment. We haven't seen that in a while because all of them have been talking about higher demand despite a 5-year upcycle that we've seen. Signature Global reported its Q3 update where the numbers did not look so good. We saw a pre-sales decline of 27%. Number of units sold were down 73% on a YY basis. Their area sold was down 42%. Their collections were up 14%. However, overall numbers looked very weak on a YY basis. And this is one of the first ones which have seen a big decline in the quarter gone by. Now, they do indicate that, yes, they will not be able to meet their pre-sales guidance of 12,700 crore rupees. They say it looked comfortable till a few weeks back. But now demand trends suggest that it could be slower than what they had anticipated. Now, remember, Signature is largely in the NCR region. They were focusing a lot on luxury segment. And this is one of the segments which has been doing really well across developers. That's at least the consensus word. So this has been an agreement to the fact that there's some slowdown, and that's the reason the stock is lower in trade. Otherwise as well, Realty Index is down sharply from the highs of the day because in 2025, we did see a lot of enthusiasm coming in the sector, but now some admission of the fact that demand is slower, and we are seeing that reaction on Realty Pack overall.
Take that point, Sonal. Thanks a lot for that. In fact, it's rubbing off on all the others as well. You have DLF, which is lower, Bombay-based players as well. Some of the likes of Oberoi Realty, etc., are lower. But like the point was made, it has been off highs for a while right now. Yash joins in. December life insurance data has come by. Yash, which company stands out?
Well, it's almost like, putting myself on a repetitive note. SBI Life, Max Financial Services, both the best performers as far as the month of December is concerned. SBI Life and Axis Max Life both have indeed grown on a very strong base also in the month of December. To speak about specific numbers, SBI Life, the new business premium, that has grown by a strong 19%. The total APE has grown by 21%. And the retail business, that is the retail APE, that has also seen a very strong growth of 23%. Remember, this comes on a very strong base. Axis Max Life, strong growth, again over a strong base. New business premium growing at 26%. Total APE growing at 25%. Retail APE growing at 26% again. For HDFC Life, it's been a weak growth in the month of December, but that comes on a favorable base. New business premium growing by 15%, total APE by 11%, retail APE just growing by about 4%. ICICI Prudential Life, it's modest growth over a favorable base for the company. New business premium growing at 25%, total APE at 32%, retail APE at 11%. Canara HSBC Life Insurance, the latest entrant into the listed life insurance space, strong growth, but the base was very, very favorable. New business premium growing at 42%, total APE at 38%, retail APE growing at 41%. Finally, LIC, it's a very strong growth, but again, just like Canara HSBC Life, the base has been very, very favorable. So the new business premium on a favorable base growing at 39%, total APE at 44%, retail APE growing at 27% for LIC.
All right, thanks a lot for that, Yash. Well, let's move on then. SEBI chairman commented on the further course of regulatory action in the derivatives market. Let's listen in to what he had to say.
In the derivatives, we have taken a number of measures, as you know, earlier, first in October 24, and then in May 25, and the last of the measures got kicked in December 25. So we are looking at the data, and after the data is there, we will be able to define our next course of action. So at this moment, I don't think that we are going to disturb anything.
All right, don't think they're going to disturb anything in the moment, and which explains why maybe perhaps BSE is high by about 3.5%, one of those rare outperformers in an otherwise very weak market. 2,300 stocks in the red, BSE holding in the green. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. Well, the earnings kickstart today and tech's going to be in focus. Let's get you a preview with Rima, who's joining in to tell us what do we expect from TCS. Rima?
Thanks so much for that. So expect a muted quarter, a dollar revenue growth of just about 0.3%, constant currency revenue growth of about 0.5%, margins unchanged at 25.2%, and a modest 5-6% jump in the company's profitability. But you know, the bigger picture for TCS is also important because there is renewed aggression seen from the company, investments that the company is making to accelerate growth. So whether it is their data center investment or even the acquisitions. And at the recently held analyst meet in December, for the first time, the company, remember, articulated its AI revenues. They said it's $1.5 billion, growing faster than the company average, is about 5% of the overall company's revenue. So more on that is what the street is awaiting. Secondly, the company up until now has always maintained that FY26 international revenue growth will be better than last year. But Ambit says that perhaps could be challenged. The company may not be able to meet this guidance. So we'll try and quiz the management on that. And thirdly, will there be any sort of an exceptional losses, one-time loss? Because there was a $194 million payout on account of an IP infringement case. And plus, generally on account of the restructuring of the workforce, will there be any sort of redundancies that the company will account? Back to you.
All right, Rima, thanks a lot for that. So that's about TCS. The big IT bellwether reports its numbers today. We'll get an inkling into what it looks like for the sector as well. Meanwhile, before we wrap up on this edition, just look at Lemon Tree. Now the stock's picking pace, up around 3%. It opened flattish, thereafter held on to some small gains, but now is higher. And the other one is Linde India, which too, on the back of decent volumes, is up around 4%. And IEX, the big gash that we saw on Friday, is now seeing some bit of recovery from the lows. IEX is up around 3.5%. Nigel. As
you said, Mangalam, on Avenue Supermarts, the valuation argument will continue because the stock, after being up close to 3%, it's actually slipped into the red. So, that continues to plague the stock. I think sustainability of these sort of margins as well as the valuation concerns. But I'll tell you what, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.